All right, let's get right into it. We're going to tackle a really important skill in accounting today, the bank reconciliation statement. It's that crucial process for making sure the cash your company thinks it has actually matches what the bank says is in the account. Okay, so picture this. It's the end of the month, you look at your cash book, and then you look at the bank statement, and the numbers don't match. It's a super common headache for businesses. So, why does this happen? Well, that's exactly what we're here to figure out.
Hello kids, this is your very own accounting teacher Adeel Paperwala. Welcome to my YouTube channel. Before watching this particular video, remember if you want to achieve excellence in accounting, you can also opt to enjoy my live classes for O-levels, IGCSE, AS and AT. If you want to study at your own pace, you can also opt to acquire my live recorded online classes as well.
First things first, to get a grip on reconciliation, you've got to understand the cash book. It's actually a pretty unique document because it does two jobs at once. On one hand, it's a book of original entry. That's what we first jot down every single cash and bank transaction. But it's also a ledger account, a proper part of the whole double entry system. So, in that bank column, if you see a debit balance, that's good news. It means you have cash in the bank, a current asset. But if it's a credit balance, that means you're in an overdraft, which is a current liability. Now, this next part is absolutely key. It's all about perspective. Think of it like this. Your business and the bank are looking at the exact same bank account, but from opposite sides of a mirror. In your cash book, your account is an asset. Money coming in, a deposit, is a debit. So a debit balance means you have cash. But for the bank, your account is a liability to them. It's money they owe you. So for them, a deposit is a credit. That's why a positive balance on your bank statement shows up as a credit balance. If you can get your head around this opposite viewpoint, you've basically cracked the code for bank reconciliation. Okay, so how do we actually do this? The whole reconciliation process is a neat two-part job, and part one is all about cleaning up our own house first. We need to update our cash book. We're looking for all the things the bank knows about, because they're already on the bank statement, but that we haven't recorded yet. So what kind of items are we talking about? Well, these are the things that hit the bank statement before we even know about them. For money going out, that's the credit side of our cash book, we're going to have things like bank charges, interest the bank has charged us, standing orders, and direct debits. And importantly, if a customer's check bounces, what we call a dishonored check, that's also going to be a credit to reverse the money we thought we received. Now for money coming in, the debit side, you'll see things like interest we've earned, dividends paid to us, or direct payments from customers, sometimes called credit transfers. All right, step one is done. Our cash book is now up to date with everything the bank has recorded. So now we move on to step two. This is where we deal with the other side of the coin, timing differences. These are transactions that we've recorded in our cash book, but they just haven't shown up on the bank statement yet. So what are these timing differences? There are really only two main types you need to know. First, you've got uncredited deposits, or bank lodgements. This is money you've paid into the bank, but it hasn't cleared and shown up on the statement yet. The second type is unpresented checks. These are checks you've written to pay someone, but they haven't cashed it yet, so the money hasn't left your account according to the bank. Now listen up, because this is the most important rule. These items are never adjusted in the cash book. They belong exclusively in the bank reconciliation statement itself. Okay, that's enough theory. The best way to really understand this is to see it in action. So let's dive into a case study. We're going to work through the books for a company called MG Furniture and put this two-step process to the test. Right, here's the situation for MG Furniture. Their cash book says they have a balance of $25,600, but the bank statement is showing a credit balance of $24,815. And of course, we've got a list of items that explain the difference. Some things are only in the cash book, some are only on the bank statement, and there's even a little error to fix. Let's get this sorted. Okay, step one. Let's update that cash book. We began with the balance we had, $25,600. Now let's fix that error. The rates payment was $205, but it was recorded as $255. So we need to add that $50 back on the debit side. Simple. Now for the money out, the credit side. We have to record that dishonored check from RJ for $420, the insurance direct debit for $110, and the $75 in bank charges. Once we do all that, our new corrected cash book balance comes out to $25,045. And now for the magic. Step 2. The bank reconciliation statement itself. We start with the balance from the bank statement, which was $24,815. Then we account for our timing differences. We add the uncredited deposit from TH, that's $910. Next, we subtract the unpresented check we wrote to JW for $680. And what do we get? A final balance of $25,045. And look at that. It perfectly matches our updated Cashbook balance. That's how you know you've done it right. The books are reconciled. So we've seen how to do it, but let's just quickly recap why we go through all this trouble. It's important to understand the bigger picture here and lock in some of those key terms we've been using. Really, it boils down to two big reasons. The first is accuracy. A bank reconciliation is one of the best ways to spot errors, whether it's a mistake you made in your Cashbook or even a rare error made by the bank. The second reason is verification. This process verifies the correct bank balance, and that's the number that has to appear as a current asset or liability on your statement of financial position. So it's about making sure your financial statements are correct. We had that dishonored check in our example. So what does that actually mean? It's basically when a customer gives you a check, you deposit it, and then their bank refuses to pay it. The two most common reasons for this are pretty straightforward. Either the person who wrote the check didn't have enough money in their account to cover it, or the signature on the check didn't match what the bank has on file. You'll see standing orders and direct debits all the time on bank statements, and it's good to know the difference. A standing order is when you tell your bank to pay a fixed amount of money on a regular schedule. Think of it for something like rent. You're in control. A direct debit is different. That's when you give a company permission to take money from your account, and the amount can be variable. This is common for things like your electricity or phone bill, where the company you're paying is the one that initiates the payment. Okay, if there's just one thing you take away from all this, make it this golden rule. It makes everything so much easier. Here it is. If it's on the bank statement but not in your Cashbook, it goes into the updated Cashbook. If it's in your Cashbook but not yet on the bank statement, it goes into the bank reconciliation statement. Simple as that. Alright, let's wrap this up with a few common mistakes to avoid so you can ace this every time. First, never ever adjust for timing differences like unpresented checks or uncredited deposits in the Cashbook. They only go on the reconciliation statement. Second, always update your Cashbook before you start the reconciliation statement. It's step one for a reason. And finally, pay really close attention to whether a balance is a debit or a credit, because that tells you if it's positive or negative. Just remember that reconciliation formula. Balance per bank statement plus uncredited deposits minus unpresented checks must equal the balance per your updated Cashbook. If those two numbers match, you've officially mastered bank reconciliation.